Brad Williams, Frugal Finance. Swaps. Just a general conversation about swaps and what their purpose is and why were they formed and why would you be interested in them. I will just do a quick overview. This may be a 2 to 3 minute overview, but just a FYI for the most part. A swap is an agreement between two or more parties to exchange a sequence of cash flows over a period in the future. Party A has agreed to pay a set rate of interest annually for the next 5 years to Party B on a sum of $1 million. In exchange, Party B will pay a variable interest rate on the same amount each year over the same duration. The parties that agree to swap are known as counterparties. The cash flows that the counterparties make are generally tied to the value of the debt instrument or to the value of the foreign currency. Therefore, the two basic kinds of swaps are interest rate swaps and currency swaps. The origin of the swap market can be traced to the 1970s when currency traders developed currency swaps as a technique to evade British controls on the movement of foreign currency. The first interest rate swap occurred in 1981 in an agreement between IBM and the World Bank. Since that time, the market has grown rapidly. By 2005, interest rate swaps were $172 trillion. I suspect that number's probably double that now. In underlying value, where outstanding in currency swaps total another $8.5 trillion. The total swap market exceeded a notional amount of 180. I think it's probably up to 600 to 700 trillion now, with about 95% of the swaps being interest rate swaps and the remaining 5% primarily currency swaps. The growth in this market has been phenomenal. In fact, it has been the most rapid for any financial product in history. That's why I'm going to introduce another 26 sessions, because this is a very popular financial instrument. The swap markets in this section, we consider the special features of the swap market for purposes of comparison. We begin by summarizing some of the key features of futures and options markets. Against this background, we focus on the most important features of the swap product. The section concludes with a brief summary of the development in the swap market. A review of futures and option market features. In our previous discussions, we delved into the futures and option markets, highlighting their distinctive characteristics and regulatory framework. Future contracts are exclusively traded in markets overseen by future exchanges and regulated by the Commodities Futures Trade Commission. Conversely, our focus on options centered primarily on exchange-traded options regulated by the Securities and Exchange Commission, which operate within a highly formalized structure with significant involvement from option exchanges. Future markets deal in standardized contracts, while exchange-traded options also adhere to specified contract terms that cannot be altered. For instance, the S&P future contract revolves around a specific set of stocks and dollar amounts with only 4 fixed maturity dates annually. Moreover, both futures and exchange-traded options typically have relatively short time frames. Future contracts are often listed around 1 to 2 years before expiration, and even when contracts for longer durations are available, liquidity tends to increase closer to expiration. Exchange-traded stock options, on the other hand, usually have a maximum maturity of less than 1 year. Consequently, these instruments are limited in their ability to address risks extending beyond the expiration of the traded contracts. For instance, if a company encounters risk associated with a major construction project, the future market provides risk management solutions only within the time frame of future contracts currently available, which typically span about 3 years. However, in recent years, over-the-counter markets for options have gained prominence, offering alternative avenue for risk management beyond the constraints of exchange-traded instruments. The characteristics of the swap market. In the bustling environment of futures and option exchanges, it's easy to spot the heavy hitters, the major financial institutions. Traders in the former futures pit can quickly identify the activities of specific firms since they're familiar with who represents which company. This is dated information, as I have stated. Today, with 95% of all trades occurring online, there are probably companies out there that track this and sell it. Consequently, engaging in exchange trading entails a certain loss of privacy. On the flip side, in the swap market, only the parties involved know about the swap, offering a level of privacy that's unavailable in exchange trading. While futures and option exchange operate under extensive government regulation, the swap market operates with minimal government oversight. Swaps, as we'll delve into later, share similarities with futures. The Commodity Futures Modernization Act of 2000 exempted swaps on financial products from regulation under the Commodities Exchange Act, the primary law governing future trading in the United States. This legal framework provided clarity regarding the enforceability of swap agreements. The International Swap and Derivatives Association serves as an industry body offering standardized documentation for swap agreements and maintaining records of swap activity. However, the swap market also comes with its own set of limitations. Firstly, to execute a swap transaction, one party must find another willing party to take the opposite side of the deal. This would pose challenges if specific maturities or cash flow patterns are required. Initially, counterparties in the swap market faced this issue as end users conducted transactions directly with each other. The swap market is facilitated by swap dealers who act as market makers. Secondly, since the swap agreement is a contract between two parties, it cannot be altered or terminated prematurely without mutual agreement. Thirdly, unlike futures and exchange-traded options where exchanges guarantee contract performance, the swap market lacks such a guarantor. Consequently, parties involved in swaps must ensure the creditworthiness of their counterparts. Brad Williams, Frugal Finance. Thanks for watching.